Hello and welcome to the Deduction, a Tax Foundation podcast. I'm your host, Kyle Hulehan, and we are back today with another episode. We have Erica York here, my co-host, and we are joined by Alex Durante, senior economist at the Tax Foundation. And we are once again talking about some stuff that has to do with the One Big Beautiful Bill. First off, we're going to start off with Erica here. What is the latest in the news with the One Big Beautiful Bill?
So the bill has passed the House. It's now sitting with the Senate. Today we're recording on Friday, June 13th, and we're expecting the Senate Finance Committee to release part of its changes to the House passed bill today. And then the reporting indicates they'll release the rest on Monday, June 16th. As long as all of the legislative text is released in the Senate on June 16th, they'll take the next week or so to work through that, make sure it follows the rules of reconciliation with the Senate parliamentarian. Then it can pass the Senate the following week. Then the House will have to agree, or the Senate and the House will have to further compromise on a final version of the legislation. And then it would go to the president's desk. So as long as they meet this Monday, June 16th deadline for all the text, they could still hit this July 4th deadline for getting the bill enacted. But there are a lot of sticking points between the House and the Senate. So we'll have to see if they can actually work on that fast timeline or if this pushes out later into the summer, potentially early fall.
So one thing we want to kind of discuss here today, switching gears back to what we want to talk about, is we want to talk, there's Social Security versus no tax on Social Security versus this senior deduction or exemption. And Alex Durante here wrote a great about this. And so let's start off with a little bit big picture. Why is taxation on Social Security benefits such like a recurring flashpoint right now in tax policy debates? And what made it a focus during the 2024 election?
The president, during his campaign, had promised to eliminate the taxation of Social Security benefits. There really wasn't, I would say, necessarily a great policy justification or policy rationale offered for doing this. I mean, if you read some of what was written at the time, I mean, a lot of it was just focused on just providing additional relief to seniors because they had experienced some cost of living increases due to inflation. Of course, they were not the only ones that experienced those cost of living increases, but nonetheless, the president chose to target them specifically for relief. And as seniors are a key voting constituency as well, I think there were also some political reasons for doing so.
So the House has now passed the One Big Beautiful Bill Act, but they didn't include Trump's promise to eliminate taxes on Social Security benefits. Instead, they did expand something that's known as the senior deduction. Can you walk us through how they expanded that, how it works, and who it's aimed at helping?
I think one of the reasons that we didn't see the no tax on Social Security benefits in the bills because it would have been very, very expensive to implement that. Our estimate put the cost at about $1.6 trillion over 10 years. The additional senior deduction would cost substantially less than that, in part because it is only scheduled to be in effect from 2025 through 2028. But if it were to extend through the whole decade, it would be between about $200 billion and $300 billion over 10 years. So it comes in at substantially less. Now, the way that provision is going to work is right now in the current tax code, there actually is already an additional standard deduction for seniors. Married filers may deduct $1,600 from their taxable income. And then for unmarried filers, the bonus is the additional standard deduction is a little bit more generous, and they can deduct $2,000. The proposal in the House bill is to add an additional $4,000 bonus per individual, and then also make that available to taxpayers that itemize their deductions. It's a bit different because it would not the specific provision would apply to all income that's earned by these recipients, not necessarily just Social Security income.
So with Tax Foundation's modeling, it shows that the senior deduction gives a larger relative benefit to lower and middle income households, while Social Security tax repeal favors high income seniors. Why is that the case?
So in some sense, by design, the additional senior deduction would not give a lot of benefits to high income taxpayers because it is scheduled to phase out at around $150,000 for joint filers. But if you compare it to the Social Security benefit taxation, um, up to 85% of those benefits are taxable. And and there are a lot of upper middle income earners that have a lot of social security income. And for that reason, they would be the ones that would be benefiting substantially from that relative to this particular additional senior deduction, which is limited sort of by design to those lower middle income taxpayers. But even if you just look near the bottom two quintiles, so this is near the bottom of the income distribution. Under current law, if you have what's called combined income under $32,000, so that includes your gross adjusted income plus any tax exempt interest income, and then plus half of your Social Security benefits. If that income is below $32,000, you don't face any taxation on your Social Security benefits. So when you compare that to the additional standard deduction, if they have other sources of income, they're going to be getting relief from that provision. Whereas they if taxation of Social Security benefits was completely eliminated, they would not be seeing really many additional benefits from that because they might already be below that income threshold.
So just to sum that up to make sure I'm getting it, like taxation of Social Security benefits is primarily something that affects like middle to upper middle to high income seniors. If you're really low income, your Social Security benefits are not being taxed under
Yeah.
current law
Yes.
versus this bonus deduction that everybody who's low middle income gets, and then it phases out for higher
Yes.
income. So it kind of just is like a reverse of the pattern of who's going to benefit.
Yes, that's right.
Got it. Another big difference between the no tax on Social Security versus this bonus standard deduction amount is how it will affect the Social Security trust funds. Can you walk us through like how the taxation of Social Security benefits fits into financing for Social Security, and if they had gone with this plan to eliminate taxes on those benefits, what would happen to that revenue?
Right. So I'm gonna have to give a bit of a history lesson here of how we got to this point. So back in 1983, the Social Security Trust Fund was imperiled, and there were several reforms that were passed to ensure that there wouldn't be benefit cuts. One of these was introducing the taxation of Social Security benefits, and what they decided at the time was that all above if you had combined income above $32,000, half of your Social Security benefits would be taxed under our ordinary income rates. Then in 1990, and then I should say that money would specifically be allocated to the Social Security Trust Fund. Um, then in 1993, there was another update to this provision where they decided to for incomes so for incomes that were between $32,000 and $44,000, you would still be faced half of your benefits would still be subject to taxation. But then above those thresholds, above $44,000, an additional 35% of your Social Security benefits would be subject to income taxation. So bringing that total to 85%. And that additional 35% would be allocated to the Medicare Trust Fund. So the issue, as you can see, so really the big difference you can see between the two proposals here is that if the president had fulfilled exactly what he had promised during his campaign and exempted all Social Security benefits from taxation, both of the revenues going to both the Social Security trust fund and the Medicare hospital trust fund would decline. And the implications of this are for Social Security, that would accelerate the insolvency of the trust fund by about 2 years. And then for Medicare, that would, so it would actually go, so it would be scheduled to expire in 2033 versus 2035. And then for Medicare, it would actually accelerate the depletion of that trust fund by 6 years from 2036 to 2030. So the fiscal implications of doing that would have been quite calamitous. And that's possibly also another reason why the president chose to give more limited relief to seniors. Although I won't pretend that really anyone in Congress or even the current administration cares about replenishing the trust funds. But nonetheless, I think it just would have been perhaps politically untenable at that point.
So wait, I need to hop in right here. I know that I work at the Tax Foundation. I'm not an expert like you guys, but am I right to be confused about what you just said? Because that sounded very confusing. Like we're going to tax 35% of this part in this area, and how they're doing the trust fund seems very wonky or confusing, at least to me.
So the way that they arrived at this number is not as arbitrary as it may sound. So in 1993, the actuaries tried to calculate the present value of tax contributions to Social Security, being that they were trying to calculate how much is that future stream of Social Security benefits worth to you today. And what they found was that the present value of those tax contributions to Social Security was equal to less than 15% of those lifetime benefits, which means that up to 85% of those benefits could be taxed without risking some kind of double taxation. And this is actually important because you kind of want to maintain some kind of horizontal equity across all of the types of saving programs that we have in the U.S. So obviously, we have either, 401k style treatment where you can put your income into tax preferred accounts. And then when you collect your distributions, you pay tax on that. Or you could have Roth style treatment where you pay the taxes up front and then deposit that income into an account. And then when you withdraw from that account, you don't pay any taxes on that additional income. So the idea with taxing the Social Security benefits is to just sort of bring it in line with these other forms of savings. Otherwise, if we didn't tax the benefits, then Social Security income would be favored relative to other types of income in our tax code.
Yeah, I think that's like the perfect key. It sounds super complicated, and there are different income levels at which the different percentages kick in. So that part's confusing. But the whole idea is let's treat Social Security benefits the same way that we treat the other types of retirement income you get, whether that's through a Roth or a traditional style account. It's just kind of trying to make everything the same.
Right.
Okay, that makes sense. I understand that. I appreciate that. So getting back to, these two policies, kind of like juxtaposing these, neither policy seems to generate much economic growth and both add to the deficit. So what should lawmakers be weighing when they're deciding these types of targeted tax cuts? And is there a smarter way to provide relief to seniors without
Right.
undermining the long-term fiscal picture?
I think one thing that would be very sensible. So what might surprise you here is that those thresholds I've been mentioning, if you might recall, I said if you have combined income below $32,000, you pay no tax on your Social Security benefits. That threshold has been in place since 1993. So that particular threshold is not adjusted for inflation, which means that more seniors are being exposed to the taxation of benefits than would be the case if that threshold was inflation adjusted. And I think that would be a sensible thing to do because since 1981, we inflation adjust many facets of our tax code to protect taxpayers from falling into those higher brackets and then facing a higher tax burden as a result. So I think a sensible thing to do that would be consistent with the rest of our tax code and would provide relief to seniors would be to index those particular thresholds for inflation.
So is there a way that we can see more economic growth here? Do you feel like there's a more pro-growth option in
Oh,
all of this?
yeah, the reform I just suggested, I mean, I think from that perspective, it's more important to have that inflation adjustment to make it consistent with the rest of the tax code. Um, would it necessarily be the most growth enhancing policy that we could enact? Probably not. And I think part of the reason for this is that I mean, if you were trying to design a particular kind of tax cut to really increase growth, you would maybe target your tax cut towards younger workers or workers that in their peak earning years, and that would be very responsive to a change in their marginal tax rates. Obviously, seniors, they're working less, they're close to exiting the labor force. So a lot of this is just providing just sort of it's just more of like just a straight tax relief, which is not necessarily a bad thing to do. And I gave a reason why I think it would be good to do it here. But really, if we were trying to do growth enhancing tax policies, I think we would have to look elsewhere in our tax code.
Yeah, and I think that makes sense. And I feel like when it comes to economic growth, there's a balance to all of this. Not every policy you're going to do is going to it might help people and that'll be a good thing. And it might not boom the economy, but that can be okay too. It just depends on the goal you're trying to accomplish. Um, but before we sign off, I just want to let everyone know if you have any burning questions, you can send them our way. You can drop a comment on YouTube, as many of you have done. You can always email us at podcast@taxfoundation.org, or you can slide into the DMs on Twitter @the Deduction Pod. Thank you for listening.